Hello everyone, Rahul Chai here, trying to make investing accessible and profitable for the average investor. How many times have you seen this thumbnail? Top 5 stocks with 100% growth or fastest growing companies this quarter. Financial influencers love these videos. They make investing look so easy. They tell you to look at the most recent quarter. They say, find the companies growing the fastest, buy them, and get rich. It sounds perfect. High growth should mean high returns, right? It makes total sense in your head. But does it actually work in real life? Do these lists help you beat the market over the next 12 to 15 months? I wanted to find out. I did not want opinions, I wanted hard facts. So I ran the numbers. And what I found might surprise you, even shock you. The data shows a completely different story. Today, we'll look at the truth behind high growth stocks. Now, I did not look at just a few stocks. I took a deep dive into the data. I put together a list of the top 500 companies on the BSE by market cap. Then I looked at a 5-year period between December 2020 and December 25. Here was the test. I found the fastest growing companies in terms of their EPS growth over the last 12 months. For example, the entire data is from June to June. So for the year 2021, the period was June 20 to June 21, and the growth in EPS was FY21 over FY20, and so on for all the years. Then I tracked the stock returns over the next 12 months. If the influencers are right, the highest growth stocks should crush the rest. Now, to be absolutely fair, I sliced the data in 3 different ways. I split the companies into 2 equal halves. I split them into 4 quartiles. I even split them into 10 deciles. Let us look at what the data actually says. Look at this first set of data from the file. We split the 500 companies into 2 halves, the top half for growth and the bottom half for growth. If you look at the cumulative returns over the study period, the top half gave a return factor of 3.65. But look at the bottom half. The lower growth companies gave a return factor of 4.2 times. The slower growing companies actually beat the high growth companies. You might think maybe the top half is too broad. Okay, let us look closer at the quartiles and deciles. Look at the first quartile versus the fourth quartile. The first quartile represents the highest growth. Over the 5 years, its cumulative return factor was 4.39. The fourth quartile, which is the lowest growth group, achieved a return factor of 4.4 times. Again, the lowest growth group won. Let us look at the extreme ends. The first decile means the absolute fastest growing 10% of the companies. The 10th decile means the slowest. Now, the first decile gave cumulative return of 5.3 times. The 10th decile gave 5 times. They are almost identical. So, everywhere we look, the conclusion remains the same. There is no real advantage to focusing only on high growth stocks. As a group, they do not generate consistently high returns. In fact, as we just saw, the lowest growth groups frequently outperform the highest growth groups. But why does this happen? Aren't fast growing companies supposed to be the best investments? Well, investing is not that simple. The biggest reason for this failure is expectations. Think of a scale. On one side, you have the stock price. The stock price reflects what people expect to happen. On the other side, you have actual business growth. So when a company grows very fast, everyone gets excited. Investors bid the stock price way up. The price now assumes the company will grow at a massive rate forever. But what if the company grows at 40% instead of the expected 50%? Well, 40% is still amazing growth. But because it missed the massive expectations, the stock price crashes. The high growth company underperforms. Now think about a low growing company. Nobody expects anything from it. The stock price is very cheap. If it manages to do just slightly better than expected, the stock zooms up. It is all about the expectations embedded in the stock price. You cannot just buy a stock because its revenue or profit grew fast last quarter. You must look at other things. You must look at quality. You must look at sustainability. Above all, you must look at the price you are paying. Is the valuation fair, or is it pricing in an impossible future? Now, I know the data is far from perfect. There could be some noise in the form of one time income or loss, sudden margin expansion or contraction, or even big dilution. However, the logic is hard to miss. Stock prices move based on growth expectations reflected in the share price and not growth alone. So, the next time you see a video with a flashy growth list, be careful. Do not just blindly buy the stocks on the screen. Now you are armed with the right knowledge. The data shows that high growth does not equal high returns. Keep your investing simple, focus on valuation, and look at the big picture. Well, that's all from me today. I'll see you in the next session. Goodbye and happy investing.